Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 23. As always, joined by the three amigos. We got Rich Diaz of Acorn Macro Consulting, the Tom Brady of macro. Welcome back, Tom Brady. Speaking of, Rich is in his chalet in Quebec, and we've got Keith Dicker of IceCap Asset Management, as always, in his Patagucci. Only the finest materials for that man. But yeah, welcome back to the show, gentlemen. I think it should be a pretty good show here lined up. We're obviously going to chat, as usual, a little bit of Canadian CPI inflation, not to beat you over the head with that. But I think more importantly, what everybody was watching this week was the U.S. Federal Reserve. So sneaking in their first rate hike, 25 basis points since 2018. But more so a lot of the lingo, right? I mean, basically, as we've talked about in the show, for Canadians, really what's important and what you have to watch is basically the U.S. Federal Reserve is the world's most important central bank. Canada essentially imports their monetary policy from the U.S. So, I mean, yeah, we talk about Tiff Macklem and the BOC, but like really what's most important is Jerome Powell at the Fed in the U.S. there. He's the one that's moving markets. So, Keith, I know you were paying very close attention to Powell's comments and whatnot. I'd love to kind of hear your thoughts and maybe your summarization on what you took away as, obviously you're running portfolios here for a living. So what's kind of your takeaway from that Fed meeting?
Yeah, absolutely, Steve. So there were, what's the best way to, for us, there were no surprises. And what we mean by that is they absolutely had to raise rates. So whereas a couple of weeks back, remember the Bank of Canada, they didn't raise rates and, it's a big shocker and everything. For the Fed, they were absolutely going to raise rates, mainly because the market has already moved rates for them, for overnight rates, basically. So you knew they were going to do that. What was really, I don't know if to use the word surprising, but most people were not, the majority were not expecting it, is that he was very hawkish with his commentary afterwards. And what that means for everyone here is in the central bank world, if you're talking about raising interest rates, making it more expensive to do things, have less money sloshing around the system, it means you're a hawk. If you're doing the opposite, it means you're a dove. So you'll often hear us talk about a central bank as hawkish or dovish. So yesterday, the Americans became extremely hawkish. So not only do they signal, yeah, we're raising rates, and the main thing. What was the main sentence he said was, he said, we're confident. Get a load of this. We're confident that the private sector can not only withstand, but they can flourish in the face of less accommodating monetary policy. So that's telling everyone, hey, we're going to continue raising rates. We're going to, and the other big thing was not only are they ending QE, but they're going to start doing QT, which is quantitative tightening. And I'll explain what that is as well. But just from an echo room perspective in the central bank world, he came out yesterday with the guns a-blazing, and he said, the easy money game is over. Everyone better get ready for it. And then, off they went. So I'll circle back again after maybe we hear from Rich.
Yeah, Rich, what's your takeaway from that?
I think, Keith's right in the sense that it was very hawkish, but I think what's, for me, the most important thing is what the market, whether or not you meet or exceed expectations and sort of what's been priced in. And so that's, for me, what I think is the market's reaction tells you that sort of a lot of the so-called damage from the reducing liquidity or raising interest rates has been sort of absorbed. And what do I mean by market damage? I mean, we're already 20% off the highs, in some cases way, way higher, way, way more. The breadth and depth of the sort of the correction in certain sectors, like the tech sector, alternative energy space. A lot of this frothy sort of liquidity driven stuff has already, I mean, in some cases we're down 30, even 40% in some cases. And so for me, what was interesting was, this is one of those classic examples of sell the rumor and buy the fact. So the fact that they raised rates and then they're sort of telegraphing their next bunch of moves, which is really in line with either the 2-year bond yield or other parts of the yield curve, tells you that in a way that, and sort of the muted market reaction, whether it was the 10-year bond yield or the rest of sort of the equity market, tells you sort of this was sort of all this was priced in. And I think that that's frankly, as far as central bank's job of sort of guiding the economy and guiding interest rates, I think he sort of stuck the landing on this one. We'll see, obviously, as things go forward with Ukraine and oil and other economic shocks and et cetera, et cetera. But my initial reaction is he did what sort of was telegraphed, and the market's muted reaction is a good one, I'd say.
Yeah, I think, I mean, there's obviously, it's interesting because of this, there's going to be a lot of people listening to the show and going, hey guys, I wish I tune into the show, every week. And you guys had 3 or 4 rate hikes, and Powell's basically sort of essentially nodding his head saying, yes, what the market is pricing in, which is, I believe, another 6 hikes this year, is very, very realistic and plausible. So, I think if some of our listeners are like, well, wow, you guys got it wrong again. Like, is any of your, I know what my view is. Like, I don't know, Keith, Rich, like, have any of your views changed in terms of the path forward for the Federal Reserve? Again, we know that inflation, basically it's, 7.98%, probably gets to double digits in the next couple months, potentially on the back of some of this inflation coming from Russia, Ukraine, et cetera. It's a tough thing because you think about it, you got inflation at 8, the Federal Reserve overnight rate is at 0.25 right now. Even if they get to 1%, you have inflation running at say 6 or 7 still as it comes off towards the latter half of this year. I mean, you still are looking at deep negative interest rates. So what in your view is the path forward here? Do you have a change of view after that hawkish speech, or are you guys still in the same camp that we're going to see, something break in financial markets, Keith?
Yeah. So my view, it's actually been further confirmed. So you're always looking for a reason to change your view or harden it or soften it. And so before yesterday, we've been quite vocal here at IceCap in that with the Federal Reserve and the other major Western central banks, excluding the Europeans, with them tightening, it is going to create a crisis in the emerging market world. So with the Fed yesterday coming out and said, hey, we're going to tighten, we're doing this or that. And not only are we going to do it, but we think our domestic economy can absorb it. That tells me they're going to continue on that path. And so we fully expect to see something happening there in the market. I know Rich said earlier, yesterday, there was a bit of a muted response in the market. The market's already responded to the Fed hike leading up to it. So it was, sell the news, buy the rumor. But, I'm sort of chuckling here today. People are thinking, oh yeah, the worst is over. Nothing else bad is going to happen in the world. This is now the bottom. And, You'll never call the bottom or the top in any market because it takes a while to sort it out. Our main equity models, which doesn't use any subjectivity whatsoever, there's no earnings estimates and all that stuff. They're still suggesting we're in for some choppy periods coming up here. So you won't know it until we get hindsight with it. But we think this is still a pretty tough market. And just to share with you again, because people talk about, they look at the stock market all the time. That's always their barometer for stuff. We like to guide people, look at the bond market. So specifically look at the credit market, okay, which is companies issuing debt. So this is a news story came out yesterday on Bloomberg, and the title is "Banks Slam Brakes on Leveraged Loan Sales as the Sure Thing Sours." So they're going through and they say, it used to be an easy sell. The banks would, lend out the easy money to companies and then package it together and then sell it out. that market is now dead. And so the paragraph that catches my attention, remember, this is like a global story. It's not specific to one country. Banks led by Royal Bank of Canada on Wednesday were stuck with $1.7 billion of loans for SS&C Technologies Holdings Inc.'s acquisition of Blue Prism Group. It's the fourth loan to be pulled in the US this year and the largest. So here's RBC. They now have $1.7 billion of a loan stuck on their books. I would imagine they're still going to value it at 1.7 until they can no longer keep it at that rate. But again, once money stops flowing, it's going to be really difficult to keep the economy, in that V-shaped recovery that people might be expecting right now. The other point, yesterday the Fed said we're going to start doing quantitative tightening, and they didn't mention it, but everyone's suspecting it's going to be with T-bills. So these will be short-term treasury bills that they bought from the U.S. government. They're maturing usually like 30 days or less. They're going to start releasing those back into the system. And the reason for doing that is maybe people have read about the repo crisis over the last few months. The repo market, that's when, if I'm a big company, big entity, I need to borrow money for one night. I'm going to borrow it from Steve because Steve has excess cash available. But Steve says, well, for you to borrow it, I want you to post some collateral with me. And I say, well, I don't have any good collateral right now because I can't get any. So with the Fed doing this quantitative tightening, they're actually releasing collateral into the overnight system for the repo market. So again, all these things, they're happening several levels underneath what most people might be hearing and listening to. And it's, again, as part of the Fed, they're getting a lot of flack for inflation running away. And I don't really think they're going to be able to change inflation based on raising rate. They can change expectations, not the actual underlying, but they needed to get credit markets moving again. So again, RBC just got stuck with 1.7 billion of a loan on their books that they couldn't sell. At the same time, the Fed is trying to make it easier, for this credit to flow. So there's a lot still happening. Like, it's not smooth sailing coming up. That was a lot of talk, wasn't it?
Right. Yeah. Rich, I'd love for you to maybe like push back on that. Like, give us your thoughts. I know, like, obviously you're like an equity bull. I think you have been for a while, and rightfully so. So I mean, what's your kind of view on all that as well? Like, I mean, how are you looking at equity markets? Like, how are you sort of, advising clientele? Say whatever you can say on the record, obviously.
Yeah.
Like, do you see it being like choppy here moving forward? Do you feel like, again, obviously, I think, like, I'm assuming your view on, like, because like my thing to you, it really is like, well, yeah, like what does stop the Fed from getting in, let's say 6 more hikes this year, in my opinion, and obviously it was to Keith's opinion, which is a financial market mishap, right? Some sort of derailment of the Fed. Otherwise, like, what excuse do they have not to raise rates, essentially, right? So I'm kind of curious to hear your thoughts on that.
Yeah, so I mean, I agree with maybe the end game. I think that eventually there might be some kind of, I think it's Ben Bernanke that says that, cycles don't die of old age; they're murdered by the Fed. And sorry if I screwed up that quote. It's a great one, and it's more or less what he said. And I think there's just a couple of things. I think we'll eventually, we'll get down the road, but between point A and point B, which is the case that you guys have outlined, I guess I'm much more constructive on the economy. And I think that what we've seen now with respect to price earnings ratios, the volatility, the earnings expectations, it allows for, I think expectations have already been beaten down so much, whether it's on the economy, and in reality, I think there's actually lots of tailwinds that I'd like to address in part. But first, I think the pushback, I think, with respect to Keith and on the EM is like, yes, I understand the EM is vulnerable, and I also agree that the dollar is important for the EM, and the dollar funding is important, and interest rates are probably. These countries are more sensitive to those interest rates. But I would also just posit that a lot of these EMs, unlike other cycles, they've done a lot of interest rate hikes themselves in advance of the Fed in a way that I don't think that that's been true in other cycles. And I think that in a way offers them some protection. The other thing is that a lot of these EMs that in the past have been vulnerable have actually benefited a lot from the commodity boom and will do so going forward. So that's on the EM side. I think that It's not, in my view, I don't think it's as clear as it has been in the past that when the Fed raises, it just screws the EM up. On the inflation thing, I think what's really important, and this sort of relates to my view on equities, is that I'm always of the view that when politicians start talking about something, the worst of it is probably behind us. In the same way that no politician was talking about inflation over this time last year, and I was banging the drum as hard as I possibly could and was laughed at and ridiculed by either colleagues or people on Twitter, only to have it explode exactly as sort of we predicted it. And I think that, and you could make the case, I think that, the oil going up $10 or whatever, or commodities hitting all-time highs because of Russia over the last 2 weeks is irrelevant. What matters is the rate of change and the year-on-year change. And all of those base effects are clear that we're seeing the last of the impulse behind us. And I think you're in a situation where you actually might get inflation, especially in the US, roll off. Again, it'll still be very, very high, but it'll give a reprieve to the Federal Reserve, which in 6 months from now, if you see inflation just rolling off, because that's the way these numbers tend to work, you have a situation where the Fed no longer has the same political pressure put upon it to raise rates. That being said, even if I'm wrong about that, interest rates will still be deeply negative, as you highlighted, Steve. And I think that what you get in that situation is you get the rotation, which is why I think it's really tough to be negative on equities in general. Like, will they outperform in the way they have in the past? Probably not. But are there extremely good opportunities in sectors that are unloved? Absolutely. Not to mention, I think the other thing is, I think what sort of the missing figure here is I think that banks in the US are extremely, extremely well capitalized. And I know I harp on that every time we get into this, but this idea that they're just going to explode, I think is wrong. I think that they're massively over collateralized. Even in the worst, the amount of cash, you could have a 10%, I think something like a 10% default on all of their loans, and it would only account for something like 50% of their cash. And just to give you an idea, that's nowhere near what happened in 2008. And so like, do I think that financial conditions will get tighter from here? Yes. But there are certain, I think that means that sectors and parts of the economy that are vulnerable to tighter financial conditions, like the bogus stuff, sure, that'll get affected. But, consumer staples, telecom providers, energy, materials, home builders. If you look at lending for consumer industrial loans, it's ratcheting up, not down. And if you look at the senior loan officer survey, they're still saying that they want to expand their balance sheets, not contract them. And so I don't think that it's I think it's just way too easy to say that the Fed is going to raise rates and that's it. The cycle's over. You don't want to be involved in risk assets. Because the alternative, sorry, bringing it back to your original question, which is how do I deal with clients, is the alternative is to buy bonds. But if you'll notice, the 10-year bond yield is a 217 today. And so if you were really worried about it, if the market was really super worried about it, recession, I'm sorry, the 10-year bond yield would not be at 220 and rising, not falling, making higher lows. So that's my pushback on that view. I don't know if Steve, you have any.
I sense another Twinkie bet here. Keith, I don't know if you want to rebuttal that. Actually, I wouldn't mind even steering this conversation as well towards what's happening with the yield curve. I think we've talked about it briefly on the show before regarding yield curve inversions and how they ultimately are sort of forward indicators or forward looking into future recessions. I think they are certainly flashing warning signals. We had part of the yield curve invert. I think post-Fed meeting there, we had pull it up here. We had I don't have it in front of me, so forgive me, but Rich is probably watching it closer than I am. So is there, what's happening with the yield curve there? And then Keith, we'll jump over to you.
Well, it just depends quickly which one you're talking about. So the 2s, 10s, we almost inverted, right? So the 2-year, 10-year yield curve almost inverted.
Which is what the 2s, 10s is what everyone kind of goes off of for. Yes. That's the official yield curve inversion. Look out, everybody. That's the 2s, 10s is the one that you want to watch ultimately.
Yes. But importantly, there's another one that people look at. And if you look at, not to be a nerd about this, but I guess you are who you are, a lot of the research that the Federal Reserve has done itself is actually you're supposed to look at the 10 years, 3 months. And that's actually going up, not down. And I think that and like, so the research at the Fed, I can't remember what San Francisco Fed or whatever has done, has tracked every recession, since the Civil War. No, I'm kidding. Like, I don't know, the last like 6 or 7 or 8 or 9 recessions or whatever. And they have argued that it's actually the 10's 3 months that is the key indicator for a recession, yes or no. I think we should just caveat that by saying that past, indicators are not something you should always rely on, because the world changes and things change and central bank policy changes. And, no one would think that we would have a central bank balance sheet this big when a lot of this research was originally, posited and thought about, et cetera, et cetera. But anyways, that's the deal right now.
Damn it, Rich. Can't you just get bearish?
I will when inflation. You know what? That's a really good question. I think I will when if earnings expectations were really, really high, and price earnings ratios were higher, and I think that the sentiment indicators were much more euphoric than they are. They're actually really, really low. I think if everyone's really bearish and expectations are really low and everyone's worried about a recession, these things, in my view, I don't know, Keith might have a different view, they tend not to happen. And that's what's really important for me right at this juncture.
Fair. Keith?
Wow.
It was shorter than yours.
Okay, so first of all, we have lots of expressions in the world, in the investment world, and one that works out quite a bit is called "Don't fight the Fed." So in this corner we have the 800-pound gorilla, the Fed, and then the other corner we have Little Richard. That's a new name for him, hey? So Rich wants to stand in front of this big steamroller that's coming along. So let's look at it from a different perspective. You guys remember you guys don't, because you're young. You guys remember the movie Silence of the Lambs?
I've seen it. I haven't seen it, but I know of it. Yes, I'm very familiar with it.
You guys have heard of it through like the Old and Goldie movies, right?
Yes,
from the 80s.
I heard it through one of your. I heard it through one of your boomer stories.
Yeah. So in this case, I'm Hannibal Lecter. And Rich is Clarice Starling, the FBI agent.
You know how that film ends, right?
And I'm saying, "Hello, Clarice." And Rich is like, "What's going on?" So Rich, why are your lambs getting slaughtered? Because
that's not the way the movie ends, Keith.
It's not the ending, but in this case, the lambs are the emerging market universe, and you're trying to get cuddly with these things. And I'm telling you, the Fed, if they continue on this path, they are just going to slaughter these lambs. So I am not going to be cuddling up to the emerging market world.
They already traded at 10. They already traded 10 times forward earnings. How much lower do you want them to go?
Earnings are irrelevant. Capital just flees. So, for example, anyone notice Chinese markets this week?
They've tanked.
What happened? No, they after tanking.
Well, no, it's because the PBOC got involved and tried to prop them up. But before that, they were selling off.
Absolutely. They had to get in and prop up the market. I also know from 2 other sources that the Hong Kong dollar got really stretched to the max this week as well. So they almost, like, again, guys, things are incredibly tight out in that world. And again, it's just me. Like, I'm not picking on any single market view or anything like that, but trying to use earnings estimates or any kind of estimates in this world, when we went from 20% rates in the 80s down to 0 and negative, with debt going through the roof at insane levels, and now trying to think that central banks can now normalize things. I just think someone's going to get screwed up along the way big time. And I know that's our view. That's our view with it. I just don't think
I don't disagree with that. But I don't disagree with that. I just think it's bonds. It's not equity. I don't think the idea that equities are going to get screwed. I just don't. I think it's too easy.
Well, hey, let's always come back to this conversation. Sorry. I think we've chatted about this multiple times, but I think you guys are still in the camp of like, at the end of 2022, the equity market will return 10%, as it has over the last 60, 70, 80 years. So I think you guys are kind of still on that. You guys, ultimately, I think we all have basically a similar view, which is the system is kind of pooched. The central banks are backed into a corner. There's really you can't taper a Ponzi essentially. And so I think we're all of that view. I think we just have a different outlook of kind of how we get there and how, for example, equity markets perform during that path. Essentially, if that's to summarize the last 25, 30 minutes of rambling, we all still are in the camp that this notion of, 6 hikes, 7 hikes, 8 hikes, we're going to get rates back up to 2.5, which is our sort of target neutral rate, I think is kind of fantasy land. And so again, I think we're just debating or deliberating on the path of sort of what trips these guys up. They'll be looking for any sort of excuse or air cover that they can. I would like to point people out to there was a great chart that was posted on Twitter by Lynn Alden. So basically there's sort of 2 more recent periods in modern history where inflation has deviated well above sort of central bank targets. So that was in the 1970s, which everybody is well aware. And in the 1970s, the central bankers began with, Paul Volcker obviously began hiking interest rates to essentially match the level of the pace of inflation. So basically inflation went up, interest rates went up. And then you have the 1940s, which was during the World War, of course. And so you had periods of very high double-digit inflation and a central bank policy that did not move whatsoever, where they actually implemented basically a form of yield curve control, let inflation run hot, because there was in the 1940s, we had a lot of debt and we were going through a war period, obviously. And so they felt it was the best policy to sort of keep rates pinned. And so, I mean, my personal opinion is I think that's kind of the era that we're in today. And I think Rich is in that same camp. Can't speak for Keith necessarily, but I think all you have to do is look at it and say, okay, well, US CPI printed 7.9% and the Fed funds rate is at 0.25. I mean, it's embarrassing. And so, yeah, kind of leads me to, I guess, our next conversation here, which is the Canada land, where we had more inflation numbers. Rich, if you want to speak to these, we'll touch on these briefly. But so I think Canada's CPI came in at 5.7% year over year.
Yeah, let me just quickly go through it. I promise I won't make it as short as possible, which is just the Canadian inflation headline was 5.7 versus 5.5, which was expected. Things that I always look at and obsess over are the shelter component, which hit 6.6. Remember, shelter component is like 40% of the Canadian CPI basket or something like that, like 33% of core. Food, which is important. Most people eat food, is 6.7. That's a larger portion of lower income families. Obviously, that's partly to do with supply chain stuff, but definitely to do with a lot of profligacy from the government end as well. Something I thought was really interesting, my last point, and I'll pass it on, which is the recreation and education, which was something that sort of doesn't really move the needle, but that's now at a 5-year high. So it's interesting how some money is getting pushed around into different sectors, and how importantly companies are trying anyway to pass on the price increases to their consumers.
Yeah, I wouldn't mind just quickly touching on that as well, just from your Canadian housing update, as Rich talked about on the shelter component there. So we also got some recent data this week from the Canadian Real Estate Association, sort of covering the national housing market. So you have the official lines. We're starting to see sales slowly taper off from all-time record highs, not to be unexpected. But so Canadian national home prices inflated 3.5% month over month. So that's a massive jump, 3.5% month over month, which actually suggests that home prices are accelerating on a monthly basis. And home prices were officially up 29.2% year over year. So you basically have 30% price growth on a national level, which is absolutely insanity. But what I will like to sort of caveat this a little bit here is a little asterisk for all of you. That national home price index, which is saying, prices are rising 3.5%, they're up 30% from last year. It's actually kind of a backwards looking indicator, just the way that home price index is sort of calculated and it's dumped into a formula. It's kind of backwards looking. So what we're actually seeing in most of the major Canadian housing markets is you're seeing activity start to slow. I think you've seen the highs for home prices, at least probably in this cycle. So we are starting to see some easing in that market. So I suspect you're probably going to see that 29.2% number. It might tick up another 1 or 2%, but I think you're going to start to see that taper off. So I think that's kind of important. I don't know, Keith, if you had any comments. I think your house there is doubled under the Trudeau government. Not to get political here, but it took just over 6 years since national home prices have officially doubled under the Trudeau government. Since he was put in power in November 2015, they have officially doubled, and that took just over 6 years. So never count on a politician to fix the housing market, because he campaigned on housing affordability, obviously, and we can see what's happened here. So, Keith, I don't know, how's your house? How's your chateau there in Halifax?
Chateau is nice. I think the housing market will fix itself. Is that what the government said once about the budget? It'll balance itself. I think it will.
Hey, well, I wonder if he's thinking about monetary policy yet.
I won't. I'm not going to talk anymore about the housing market or the. Well, to tie the inflation story, though, it's another interesting story that I'm looking at. So again, the title is Trudeau's finance chief has more room to spend in the April budget, right? So the gist of it is, because they say commodity prices, but as when you're most looking at oil prices have gone up, it's going to bring in more tax revenues coming in. And so the way this story is written, and government policymakers, they're deciding how much to spend. They're saying, hey, this is awesome. We have more revenue coming in. And then the article goes on to say it gives them even more money to spend. Like, again, it's nothing about, wow, we got a bit of we don't have to spend as much as we had to with our original plan. Instead, let's use this to pay off some debt or whatever you want to do with it. The government response is always spend, and spend some more. And so they're viewing this as a positive thing. They have tax revenues coming in. However, as we here on the Loonie Hour know, with all this new tax revenue coming in, where is it really coming from? Higher gas prices at the pump. So it's already been taxed. It's coming out of everyone's pockets. So again, there's always good inflation and bad inflation, and right now Canadians are just paying it up through the nose to put gas in their car, or Steve can put it in his yacht, whatever he's driving around out that way. But again, just to let you know, from a government policy perspective, any dollar they find, they want to spend it again and again and again. So it's not a good thing, guys. I've never been so underwhelmed with these policy decisions that I've seen over the last few years. And it doesn't matter if it's coming from red or blue or left or right or up or down. These guys are pushing everything to the max.
Well, it's rather ironic, because I remember these guys brought in a minister of the middle class, and it's kind of the timing of that was rather ironic.
I've got something to say on that.
I didn't know that. We have a minister of the middle class.
Yes, they're around for about 18 months. And I think that they couldn't define the role. I mean, probably because there actually isn't a middle class anymore. So officially we don't have one anymore, but the Trudeau government did bring in a minister of the middle class. So that was
next thing you know, they'll have like a Greenpeace guy as head of, the oil patch.
Yeah, that was almost like a like that was like a sentiment indicator for like the top of the middle class, and anyways, Rich, I don't know if you have any comments on.
Well, I just want to say, what I think is really I think when it's just, we talk about inflation, food is at 6%, 6.6%. We know it's probably higher. We talk about shelter going at 7%. We probably think it's probably higher, and we know that wages aren't catching up, and it's important because what matters really, but yet you talk about housing, and housing is up 30%. And what just strikes me as incredible is that I'm going to be political because I think it's important, because this nominally left-wing government has basically given a massive, massive windfall to the richest, and I'm going to dare I say whitest part of our country. And I think it is just frankly, and so this is why I get so vexed about these policy stances, refusing to raise interest rates, refusing to cut spending, because it basically, it's sold to us as this, as this like savior. We're going to help emancipate the middle class. But I just want to point out a little statistic that I think is really important, and it relates to the 30% rise in house prices. In the U.S., they have home ownerships by race. And I know you guys didn't think we were going to go there today, but I think it's an important thing when we talk about 30% house price increases. In the US, they have home ownership by race, and non-Hispanic white home ownership or owner occupiership is 75%. They don't have the data for Canada, but let's just assume it's roughly the same. For Black people, it's 43% in America. For Hispanics of any race, it's 48%. All other races, it's less than 60%. And I just want to point out, so when you see these house price increases, massive going up, and it's just, it is a bifurcation of the net worth distribution in this country and income inequality based on class and race in a way that I don't think we've ever seen. And I think it's just a really kind of pernicious, nasty thing that no one ever talks about. And I thought it was important to at least address in this venue. In a non-political
demographics,
way, I think it's very important.
Demographics. I mean, if you look at the cohort again. Sorry, Keith, but obviously the boomers are benefiting tremendously from this, and the millennials such as Rich and I. I see it day to day in my business, right? I mean, again, I'm not going to poo-poo things here at the end of the day, but skimping out on your avocado toast isn't going to move the needle. It is what it is, and so I think it's like I said, it is rather ironic because I see it in this market. Basically, so in Vancouver, one of the most the expensive housing market in Canada, the play to pay or pay to play token basically is like if your parents are on the housing ladder, you're basically good. So they basically will take some equity out of the house. They'll refinance whatever. They give you $200,000 as your down payment. And that is as little Johnny's sort of golden ticket into the housing market. And now he's part of sort of like the Ponzi scheme or whatever you want to call it. And so that really is. So it is kind of very interesting because if you talk about sort of social classes, it really is like, well, it kind of depends on how your parents did in life. And, if they, did well through their asset accumulation, little Johnny will have at least a competitive advantage against his peers. So, I mean, it is what it is. Nothing's really, in my opinion, nothing is going to change. I just find it very interesting from a sort of social experiment, so to speak. And obviously a lot of the policies that have been implemented over the past decade in particular have exacerbated that divide.
I guess it's sour grapes from us.
Steve, I have a question for you. So in your like day-to-day work, do most people think the housing market is fairly priced, or do they think it's a bubble? And if they do think it's a bubble, why do they still want to buy? I'm just trying to understand the general anecdotal perspective.
No, it's a good question. I think there's so I think genuinely, like we actually like we literally like joke about this like in our like office, like we call it like the faith. Like people just have this unbelievable faith in the housing market. Like you got to have the faith. There's no price too high. Like faith in a 30-year bull market that is unequivocally supported by every level of government, regardless of what they say to you on TV. Like every policy that they put in, anytime the housing market wobbles, they come in and they give it a boot to get it going again. And so I think there's this there's this deep down rooted faith. And if you think about it, like even the millennials that are getting, $200,000 down payments, it's like, they're like, well, listen, look, hey, mom and dad's house went from $100,000 to $1.8 million. Like that's my golden ticket to my retirement as well. Just follow the same path that mom and dad did. Even though again, we know they're different paths because mom and dad rode bond yields from 20% down to 1%. But that is the faith. I think that I am seeing, at least today anyways, I think from some of the sort of more astute investors, is we are seeing they're looking at Vancouver and Toronto housing markets in particular and saying, well, man, these things really look pretty fully priced. I mean, is my 1-bedroom condo really going to go from $800,000 to $1 million in the next couple of years? I don't know. And so we actually are seeing a wave of capital into other parts of Western Canada, in particular, Alberta. It's unbelievable right now just to see that housing market booming. I think what people are doing is they're basically taking all their sort of inflated gains that they've received in those two markets that, through no hard work of their own, have just ballooned by $1 million, and they're refinancing, a couple $100,000 of that to go buy, dirt cheap property in Alberta. So that's really the trend that I see at the moment. But to long story short, Keith, come back full circle, is I think people don't really, there's a small portion of society that thinks it's overpriced and it's going to actually correct. I think they probably do agree that, yeah, valuations are really high and stretched and it's kind of insane, but people believe that the government literally will have their back, and that it's can't lose mentality in the Canadian housing market.
Can I ask a follow-up question, which is, given the interest rate expectations, and obviously Keith and your view and our views that they're going to raise rates until something breaks, and that seeped into the mainstream media, has that at all affected the people's sentiment with respect to this faith?
I mean, it's a good question, because I was actually going to try to loop this into the whole podcast here. It's like I said, I think we are seeing this on the ground. It's not showing up in your data yet. Give it 2, 3, 4 months from now, that will show up in the data. But we are seeing sentiment has changed in the two sort of big frothier cities in Vancouver and Toronto. 100%. People are saying, as opposed to like, oh my gosh, I got to get in, which was like 6 to 8 weeks ago. Everyone's like, oh, I got to get in. Prices keep going up. They're going up so fast. To all of a sudden, hey, hold on a minute. Interest rates are going up. They're expected to go up, another like 7 times this year. Plus inflation, like that's $2 a liter to fill up my gas tank. There's a war in Ukraine. Like, sentiment has changed. So I would say in basically two of Canada's largest markets, you are seeing home purchasing activity slow, I would say fairly significantly. But yeah, but if you, again, there's not really a national housing market. If you look at Alberta, that market is actually accelerating. So yeah, it's interesting. But again, it's accelerating because if you look at it, like if you zoom out 10 years, it's historically cheap. It's like that. It's like the value trade in the equity market. It's like
10 years. That's crazy.
Can I ask one more follow-up question? One quick follow-up question. So one of the data points we didn't talk about is the Canadian employment data that came out last week or this week. I don't know. Anyway, I'm confused because I'm on vacation. Anyways, the employment data was 330,000 new jobs created in Canada, which is excellent. And the unemployment rate fell, which is obviously really good. But a third of those jobs were in the construction sector, because I guess that's all we do. But I was just wondering on the supply, so that we know the demand and the sentiment on demand is changing. But I was just wondering if you saw supply and sort of it's changing, and if you think that that's coming on finally, whether it's new construction or just people saying, hey, I'm going to put my house on for sale after 2 years of not doing so.
The supply side is very slightly picking up, I think. So what I've basically been saying is, like, what's happening right now in the housing market is the demand is slowing. So you have fewer home buyers. The sentiment has changed, most importantly, which is kind of, the changing of the bull market. So the sentiment has changed. I think the only thing that's underlying that is really supporting these valuations right now is the fact that you still have essentially record low inventory. And it's going to take months and months and months and months to get that inventory from crisis levels to at least like a balanced level, where you then start seeing, I think, price cutting from sellers. And so that's really the biggest thing. I think there is, if you look at the pipeline of homes under construction in Canada, it's quite full. I think there's a lot of new housing construction coming to market over the next several years. I'm not necessarily bearish on that. I think that we desperately need a lot more housing supply. I do think, to your point of the construction hiring, that we talked about this offline with a couple buddies in the industry. There is a acute shortage of like skilled tradespeople, and I don't see that getting better anytime soon. So people always like, oh, we just need to build more housing supply. So, well, good luck. Go find a couple framers for me. Like, we are building at capacity. I don't think it's that easy to actually dial up the supply. And if you think about all these, like a lot of these, there's no millennials that are like, I want to be a plumber when I grow up. Like, they're all going into like, they're all trying to start the next Facebook in tech. So like everyone, the skilled labor, blue collar jobs have been kind of left for dead. And so there's like a shortage of them. And I think that a lot of these, the older sort of skilled trades people are actually nearing retirement over the next 5, 6, 7 years. So I'm kind of curious. I think we're going to ultimately rely on immigration for a lot of the future home builders in Canada.
I just want to touch 1 second on the employment data that comes out. So the Canadian monthly employment data, it is the worst out of all the data releases in Canada.
I was going to say that too.
Yeah, it is. So for example, the latest number, and I say it's the worst because the Canadian economists at the big banks, like, they're really good. Like, this group of professionals, they're extremely sharp. And this is the one number they miss by a mile every single month. So this latest month, the actual number was 336,000, and their estimate was 128,000. So it's like they missed by almost 3 times. The other thing to think about, the previous month, it was a 200,000 number loss in terms of jobs for the country. A few years back, for the American data. So America is what, 10 times bigger population, basically?
Yep, roughly,
okay. Yeah. A typical monthly payroll number out of the US would be between 300,000 and 600,000. Like, that's typically where it would go. During bad times, 300, or even the low 2s. Great times is 600 to plus. All of a sudden, Canada's having prints at 300,000 plus. Again, this number is it doesn't, we never put a lot of weight on the Canadian employment number. Well, the point you made, though, Steve, about, this is a bit of a, just not philosophical, but just thoughts on life and everyone. So when I was younger, everyone had to go to university. You were going to university to get an education. And, years later, and even today, it's like, well, is it worth it anymore? Do you need to go to university and pay $10,000s of dollars to be educated when you can get a lot of these educations on YouTube today for some of these degrees that they do? And then you have the trade side of it. So here's a shout out to one of my best friends is a guy from Winnipeg, and one of his best local friends, his name is Bloomer. Anyway, he started out as a roofer. So the young guy, if anyone knows the roofing industry, man, is not an old person's game. It's backbreaking work. Anyway, years later, he's one of the most successful roofers out there in the Winnipeg area. If he's listening to this, God love you. I'm good friends with your mate, Scott. But here's a guy, they got trade. He has, so many other people hired doing the work. And as you said, Steve, like, it's hard to get people today to do work. So, anyone today, they're trying to find their path in life. Don't be swayed by this thing. You have to go to university. Maybe it is a trade. Maybe that's what you need to do. Or if you do go to university, become an economist, and then you can help Rich out to get his emerging market story a bit better.
I mean, I would say that most of these trades, like based in Vancouver, I know a lot of, you're minimum six figures minimum. I know guys making, like, this is the funny thing is, like, if you do a small renovation, like, nobody wants to do them anymore because everyone's like, I'm so busy, I don't have time for these little jobs. Like, plumbers bill out now at like $50 an hour. Like, it is pretty wild. Yeah, Keith, to get back to your point, we call that the employment figures in Canada, the random number generator. But it's almost like Canada's CPI, right? Because I think people were like, that number came out at 5.7. Like, well, hold on a minute. The US just came out at 7.9. Like, how the hell are we at 5.7? And so, I mean, there's always, like, again, guys, you have to kind of keep in mind, the data isn't perfect.
You have to look at what is the estimate from the economist community, and like the inflation number, they're pretty again, you're playing the game that you're giving, the sticks and pucks with the play. And the Canadian guys are pretty good with the inflation data that comes out. It's just the employment numbers they're one tough one.
Rich, what's the one on the inflation in Canada, though? I don't think they don't include used cars, right?
Oh, you got me. Sorry, I don't know the answer to that question.
I think Canada's CPI does not include used car prices, which I think in the US are up like 40% year over year. So that by removing that, important metric, I think that sort of sways some of the CPI there.
Guys, yeah, well, that's important. Sorry, one last thing. I know you got to go, but the other thing is just like that's why it's important to look at sort of the BOC's like preferred measure of inflation, where they do medians or trimmed means, and the US is the same. They do they do stuff that excludes transitory or crazy items. Sorry, Keith, you're gonna say something?
I just want to finish. Yeah, it's sort of like with market related. Sort of like, last week I told the Velcro man suit story.
People like that a lot.
People like that story.
I know it's great because they could just, picture, Keith ramming into a wall. But the point of the story was pointing out to oil market. So back then oil had hit 130 the day before. And I said, it's likely you're at the top. We've had that, big sell off in oil prices here. So the next contrarian trade that's out there is actually to be long the 10-year bond market. And if we are headed for a slower economy coming up, and in the US specifically, it doesn't have to be a recession, but slower. And we know what they're doing at the front end of the curve. We can easily see, the 10-year. It may have troughed this month. So, as Rich pointed out, you want to, buy things when they smell and sell them when they smell. You didn't say that, but something like that anyway.
I'd like to
sell them when they smell nice.
Keith, I think we should add an asterisk next to your comment there, which is Keith is not saying that he's holding this 10-year bond to duration. It is simply a trade, a shorter term trade.
Tactical trade.
It's a tactical trade. Do not hold that bond to maturity. You will be slaughtered. But that is probably a good way to end the show right there. So you guys,
you said the word slaughter, which reminds me of Clarice Starling and her lambs, right?
I don't think what that movie doesn't end the way you think it does. But anyways, that'll
it's not the ending. It's the middle part of the story. The emerging market world is going to get slaughtered.
Now there's some homework here for our listeners. You can go watch Silence of the Lambs. We threw in some tactical trades there, some housing updates, forward looking on what the Fed's going to do. So as always, we hope that helped. We appreciate your support. All we ask is that you share this episode with at least one person. Let's continue to build the Loonie Hour community. We touched on it last week. We are still working on the final details of organizing a live event in Vancouver for the Loonie Hour. We'll kind of do like a live podcast, happy hour mingle, couple drinks here and there. So stay tuned for those details. Hopefully unveil those fairly shortly. But again, as always, we appreciate your support and we'll see you next week.